Hello everyone, welcome back to our Forex training series. I'm really glad to see you here again. Before we start, please make sure to subscribe to the channel, hit the like button, and turn on the notification bell so you don't miss any of the upcoming classes. And remember, this series is completely for beginners. You don't need any previous knowledge of Forex. I'll be teaching you step by step from the very basics. Last time, in Module 1, we covered the introduction to Forex. We learned what Forex is, the foreign exchange market where currencies are traded. We discovered why people trade Forex, the opportunities, but also the risks. We talked about who the participants are, from central banks to retail traders like us, and we saw just how massive this market is. Over $7 trillion traded daily. So now that you know what Forex is, let's take it a step further. In this module, we'll learn the basics of currency trading, the building blocks you need to understand before you ever place a trade. Module 2, Basics of Currency Trading. 1. Understanding currency pairs. In Forex, we don't trade single currencies, we trade them in pairs. For example, Euro to US dollar. The first currency, Euro, is called the base currency. The second currency, USD, is called the quote currency. So if Euro to US dollar equals 1.1000, it means 1 euro equals 1.10 US dollars. Example. If the price goes up to 1.1200, the euro has strengthened against the dollar. If it falls to 1.0800, the euro has weakened. 2. Base currency versus quote currency. Think of it like this. The base currency is what you are buying or selling, and the quote currency is what you're using to measure its value. Example, pound sterling to Japanese yen equals 190.50. Here GBP, British pound, is the base. JPY, Japanese yen, is the quote. It means 1 pound equals 190.50 yen. 3. Pips. A pip is the smallest price movement in Forex. It helps us measure profit or loss. For most pairs, 1 pip equals 0.0001. Example, if Euro to US dollar moves from 1.1000 to 1.1005, that's a movement of 5 pips. Why do pips matter? Because they help you calculate how much you gained or lost on a trade. 4. Lots. When we trade Forex, we don't buy just 1 euro or $1. We trade in units called lots. Standard lot equals 100,000 units of currency. Mini lot equals 10,000 units. Micro lot equals 1,000 units. Example, if you trade one standard lot of euro to US dollar, you're actually trading 100,000 euros against the US dollar. Don't worry, you don't need to have all that money because that's where leverage comes in. 5. Leverage and margin. Leverage lets you control a large position with a small amount of money. Example, with 1:100 leverage, if you have $100, you can control $10,000 worth of trades. But be careful, leverage is a double-edged sword. It can multiply profits, but it can also multiply losses. Margin is simply the amount of money the broker locks up to keep your trade open. Think of it as a security deposit. 6. Forex trading sessions. The Forex market is open 24 hours, 5 days a week, but it doesn't move the same way all the time. There are 3 main trading sessions. London session, very active, lots of movement. New York session overlaps with London, usually the most volatile time. Asian session, Tokyo, quieter, but good for certain pairs like JPY. Example, if you're trading pound sterling to US dollar, you'll see the biggest moves during the London and New York sessions. Great work! In today's lesson, we broke down the basics of currency trading, how currency pairs work, base versus quote currency, pips, lots, leverage, and margin, and the different Forex trading sessions. This is a foundation every beginner needs before moving on to strategies and analysis. If you enjoyed this class, please like this video, share it with your friends, and subscribe to the channel so you can continue learning Forex for absolutely free. In the next class, Module 3, we'll learn how to set up for trading, choosing a broker, using MetaTrader, and placing your very first trade. See you in the next class.